And we should be live on our social media channels. Iman, if you can just confirm that for me, that would be greatly appreciated. And now I can go ahead and share my screen. Again. So thank you everyone for taking time out of your busy day to join us on this session. We're going to be talking about salary versus dividends and how do you pay yourself, and the pros and cons of the different strategies. So without further ado, I want to start with a little bit about ourselves. My name is Andrew Wall. I'm the managing partner here at CPA4IT, where our mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. And of course, tax planning is an important component of that, which is why we're delivering the session today on the difference between salary and dividends. I know many of you have questions as to whether you should choose one or the other, whether you should combine the two. And today we're going to hopefully debunk some of the myths around dividends and give you guys some strategies that you can leverage for your own individual tax planning. Of course, I always encourage you to work with your financial advisor, whether that's our team or if you're not a client, your existing accountant to do your official tax planning. But having this knowledge and understanding of the difference between the two strategies will be invaluable in your long-term planning. So, sorry. So some of the key factors to consider when evaluating whether to choose a dividend or a salary is to look first at the income level of the individual. So we want to know and understand how much income do you have coming from your corporation, as well as potentially other sources, as well as what other types of expenses that you might have. You want to look at and understand what your individual cash flow needs. And when we talk about some of the pros and cons of the different strategies, you'll see why that's important. And we'll want to look at what the predicted income is of the corporation for the coming year, as well as what it's been for the past year. Then we'll want to know and understand the age and the long-term goals of the individual business owner. And finally, whether RSP contributions, or CPP are important factors for the business owner. And these are the factors that we go into the tax planning and making the decision as to whether you want to go on a salary versus a dividend. And the reason that we want to look at all these different points is because there is situations where one strategy will outweigh another, despite the general rule that we're going to give you, which is during your income earning years, salary is usually the recommended strategy, and during your retirement years, dividend is your strategy. Now, there are exceptions to that, and those depend on your individual situation, like your cash flow needs, what income levels you're going to be at for both the corporation as well as the individual. And we'll explain these further as we dive into the sessions. Now, Stephen G, you have raised your hand. Do you want to, are you doing that because you have a question and you'd like to be allowed to speak? Is that why? If that's a yes, can you just uh, uh, post in the Q&A that yes, you'd like to ask a question verbally, and I will grant you permission to speak. Actually, I'll allow you to talk now. Steve, did you have a question or was that just a mistake? You're muted, so I'm going to assume that that was a mistake, and I am going to remove your permission to talk and continue on. So let's go into some more factors when determining, and knowing and understanding the difference between the two. So we've covered some of the factors that are deciding between the two. So let's explain the difference between a salary versus a dividend. And first of all, what we also want to talk about is the difference between a salary and a director's bonus or an annual bonus. And so a salary is a payment that's made by an employer to an employee, typically expressed as an annual amount, but paid in intervals, whether that be weekly, monthly, quarterly, or what have you. And this is going to be subject to payroll taxes, including income tax, CPP, and in some cases, employment income. Now, this is monthly for most people, ongoing payroll, and requires monthly remittances to the CRA. What many of our clients do is they will take money out of their corporation in the form of a loan or a director's advance. And at the end of the year, they will look at how much money that the business loaned them, how much money that they used from that loan to pay for business expenses, and that delta will become the annual bonus. So the difference between what they took out and what they spent on directors' advances is their net directors' advances and what they will need to declare as an annual bonus. The advantage of the annual bonus is that you're not having to pay monthly payroll remittances. Payroll is always required to be paid. Payroll remittances always required to be paid in the period following when you've paid your employees. Now, if we declare the bonus as an annual, that means that you typically don't have to pay the payroll on that until January 3rd. Now, we have a whole payroll session that goes through the difference between the different deadlines for payroll remittances. But if you're paying yourself monthly, you need to remit payroll taxes monthly. If you are paying annually, you get to remit annually. Even though you're a monthly filer, you just have no employees with any eligible remittances during those periods. Now, a dividend is different. It's a distribution of the corporation's profits. What this means is these are coming out of after-tax earnings, out of the retained earnings of the corporation. And because of that, you're not getting an expense in the corporation. And because you're not getting an expense in the corporation, you will get something called a dividend tax credit personally, which lowers the amount of taxes that you pay on that dividend income when compared to a salary, whether that be a monthly salary or a director's bonus. Now, what often happens with the confusion here is that people think that you pay less tax on a dividend because you get that dividend tax credit. And you have to remember that the only reason you're giving the dividend tax credit is to offset the taxes that the corporation has paid already. And there's something called the theory of integration, which basically is intended to integrate both the corporate taxes and the personal taxes and make it such that there is no benefit from a tax perspective of choosing one over the other. Now, there are other differences, and we're going to go through those in just a second to explain what the differences is between the dividend and the salary if there's no net tax difference between a salary and a dividend when you combine both the corporate and the personal taxes. So first we'll start with salary, if I can just get this to work. So the benefits of the salary is it's going to increase your RSP contribution room. So it doesn't make a contribution for you automatically, but you're going to get 18% of whatever salary you receive in eligible RSP room. It's also going to be give you the ability, well, not actually the ability, but you are actually obligated to pay both the employer and the employee portion of the CPP. Now, this we have as both a pro and a con, because in my opinion, this is a pro. It's sort of a forced savings that forces you to put the money towards your retirement, because the way CPP works is obviously you make contributions during your income earning years. And once you are retired and collecting CPP, you receive those funds back. This is also a con in that it is a cash outflow that has to go out today. Now, of course, the salaries and the bonuses will be a tax deduction for the corporation, as I mentioned earlier. And there is more opportunity for income splitting by paying your family members a salary. Now, it's not that there is no possibility to do dividends, but unfortunately, the lovely Liberals introduced something a few years back called TOSI, or tax on split income, which basically took away a lot of the income splitting strategies we used to be able to leverage with a dividend. And we'll talk a little bit more about that in a second. But the other thing to be aware of when it comes to salary is that this is obviously 100% taxable personally. There is no dividend tax credit that you're going to be receiving. And you do need to make monthly or annual payroll remittances to the government, which is going to be due before the taxes would be due on a dividend. So from a cash flow perspective, you're going to have to pay the tax on a salary sooner than you will have to pay the tax on a dividend. Now, looking at dividends, they're obviously the opposite. They are going to be eligible for the dividend tax credit, which means you're going to pay a lower tax on that personally. You don't have to pay into CPP, which is going to be good from that cash flow perspective. But on the negative, again, it's not eligible for CPP, so you're not making that CPP contribution. It does give you a better cash flow because it allows. So what happens is that there's no tax paid by the corporation when it issues a dividend, other than the corporate tax on the net income of the corporation. But there's no withholding like there is with salary. However, the individual receiving the dividend or the shareholder will have to pay the taxes when they file their tax return in April, which means that you are usually getting more time, whether that be from a monthly remittance or even a January 3rd deadline, all the way till April 30th, which buys you a bit of time from a cash flow perspective. They're also not subject to a reasonableness test the way salary is. So if you are doing income splitting through the use of dividends, you can give any amount that you want as long as it's not subject to these TOSI rules. And there are some exemptions to TOSI, tax on split income. Most notably, if you, the primary shareholder, are over 65 and your spouse is a shareholder, then you can do dividend income splitting with your spouse. So there are some options available for income splitting with dividends, but the TOSI rules were really targeted at income splitting with children and spouses who were when you were under 65, so before retirement age. And so now you can still give a dividend to your spouse or your children. However, those dividends will be subject to TOSI, and as a result, you're paying a higher tax on those dividends than if you were to declare it as salary. So while they haven't made it impossible to do income splitting through the use of dividends, they have made it impractical, making it tax inefficient to do so. The other thing to be aware of about your dividend income is that it's not going to increase your RSP contribution room, and it's not going to be eligible for some deductions, most notably childcare. So if you're receiving dividend income and you've got childcare expenses, you're not going to be able to apply those childcare expenses against your dividend income to reduce the amount of taxes that you pay personally. So those are a couple factors to be aware of when it comes to dividends. Now, when it comes to salary and dividend tax planning, this is where it gets a little bit complicated. So we've said, okay, there's no difference between the tax when you net the two taxes beforehand, but there are some situations where either a split between salary and dividend makes sense, or going with 100% dividend is beneficial over salaries, even in an income earning year. So in an income earning year, typically you're going to have you're going to have income, gross income, where you can apply expenses against it, including your salary. Okay, sorry, we've got a question coming in here, so I'm going to try and answer that. Why would I pay more tax if I pay dividend to my family members based on the CRA's new TOSI rules? Because there's an additional tax on split income, which is what TOSI stands for, that you're going to have to pay. So not only are you paying the corporate taxes, and the individual is paying the regular taxes, which in all other things being equal, there's no benefit salary versus dividend, but now you have this additional tax on split income, which means that you're paying more tax than you otherwise would. And it's been set up to effectively bring the tax rate up to the highest possible tax rate personally. So the only situation in which it would make sense is if you wanted to do income splitting and the person was already over the highest personal tax rate at like 54%, which still is not a very effective strategy, or not a very tax effective strategy. So I hope that answers your question. Now getting back to sort of tax planning. So let's step back for a second to the overall high level strategies that are, not to be used without understanding your personal situation. But generally speaking, we say during income earning years, it's preferable to pay yourself a salary because you're going to have income inside the corporation that you can apply a salary against, which means that you're not paying the corporate taxes, and you're going to get you're going to get a deduction inside the corporation that's equal to the full amount of the salary, reducing the amount of corporate taxes that you pay. Personally, you are paying the full marginal tax rate, and you're going to be eligible for CPP and you're going to be eligible for RSP, which we personally believe are good things for you to be contributing to. And we've got a whole other sessions on the different investment tools and how to leverage them. But we do think RSPs are an effective tool, and we do think CPP is a great tool of forced savings towards retirement. Now, whereas if you're in retirement and you don't have any income to apply the expense of the salary against, you would generate a loss. And a loss can be applied backwards up to 3 years, but beyond that, the loss will only carry forward. And if you're retired and never planning to come back to work in the future, you are never going to be able to apply those losses against any income. And therefore, you now have paid the full personal tax rate, but got no offset inside the corporation to reduce the corporate taxes there. So we got another question that comes in. Besides childcare deductions and limitations, what other expense deductions are impacted by the dividend option? The other one is moving expenses. For most of our clients, that's not very applicable because most of our clients, their office is their home office. And the requirement for moving expenses is you have to be moving a certain number of kilometers. I can't remember exactly how many it is, closer to your office in order to qualify for the moving expenses. And again, for our clients, you're never moving closer to your home office than you are because it's in your home. So that's another one, but it's for most of our clients not very applicable. Hope that answers your question. And now getting back here to the situations where these high level strategies aren't applicable. So again, first would be you just don't value CPP or you don't value RSP, and you don't want to pay into those. So again, from a cash flow perspective, if you take a dividend, you're not paying into CPP, you're not making contributions to your RSP, so less money is going out, particularly with CPP, which would be taken off as part of the source deduction remittance and given to the government early on. So you can potentially hold on to that money, invest it, generate a return with that. But let's also say that you've got a situation where you're working, but you are spending more than what your corporation has earned in income. And if you were to take it all as salary, you would have a loss. And if you, again, didn't have a net income in the prior 3 years, that loss wouldn't carry forward. So in situations like that, we might either switch solely to a dividend strategy, or if we're still valuing CPP and RSP contributions, we might do a split where we take salary, which is enough to bring the net income down to zero, and take the remainder of the funds that you need for your lifestyle out of the retained earnings in the form of a dividend. So great, we've got some more questions coming in. How will the alternative minimum tax affect the withdrawal of dividends in 24? Is there a sweet spot reflective of one's tax bracket? You can answer this later if you touch on the subject. So we don't have any more sections on this. Now, again, this comes back to that theory of integration, and people have done a variety of calculations over the years trying to see if there is a point in which the net tax is better one way or the other. And there are very, very slight, we're talking within $5 to $10 differences of one being better than the other. But effectively, there is no tax. Um, um, there's no tax benefit of choosing one or the other at any income level. And that's because effectively what happens is, and they do it in a complicated formula. What happens with a dividend is it's grossed up and then you get a dividend tax credit. But that gross up and dividend tax credit amount is intended to offset the taxes that are paid within the corporation. You are still taxed on a dividend at whatever your marginal tax rate is. You just happen to be getting a gross up and then a tax credit, which is meant to offset the taxes. Now, again, we have different types of dividends. So there is something called an eligible and a non-eligible dividend. So an eligible dividend are dividends that have been paid from corporations who have paid tax at the general rate, which is higher than the small business rate. A non-eligible dividend is a dividend that has been paid out of retained earnings that have been taxed at the small business rate, here in Ontario at only 12.2%. So because the corporation has paid less tax, you get a lower or non-eligible dividend tax credit. But again, all these things are intended to make it, whether you're getting an eligible or a non-eligible dividend, whether you're in a low tax bracket, a high tax bracket, a medium tax bracket, that there should be no tax advantage of choosing dividend over salary or salary over dividend. And like I said, in all the calculations I've seen over the years, I've never seen more than a few dollar difference. Now, where we get a lot of miscommunication on this subject is when people say you'll pay less with a dividend, and that's because they're either including CPP as a tax, which it is not. So a payment into CPP is not tax. It is a contribution you're making towards your pension, and the amount of pension you receive is directly correlated to the contributions that you make. It's not a tax. And that's usually the misconception. The only other misconception that often happens that most people usually catch on to is the fact that the dividends, while you're paying less personal tax than the salary, have been taxed already. So you have paid some tax, whether that be the general rate or the small business rate, you have paid tax on those dividends already. And when you factor in that tax, as well as the tax you're paying personally on a dividend, those two should equal the amount of taxes that you would pay on a salary. Now, again, we're talking taxes only, not CPP and not EI if you are opting into that as a business owner or an arm's length employee of that business. So I hope that answers your question. And I really want to open it up now for Q&A, because we've really sort of covered the basics of it. My accountant always tells me I should pay dividends to save taxes, so I guess this is incorrect. Incorrect may not be the right word. It is misleading. Again, you are saving cash flow. You are paying less out versus what the amount is you would pay out if you were making payroll remittances. But that's again because of CPP. So it is a misnomer or a misrepresentation to say you're paying less tax. You're paying the same amount of tax, but you're paying it in different ways. You're paying corporate tax as well as personal tax, and you are also paying into CPP, which is not a tax. Now, again, another reason that we're not a fan of dividends over salary during your income earning years is, again, the nature of our client base. We're dealing with independent contractors, primarily in the IT world. And one of the biggest issues here is personal service business risk. And with personal service businesses, if money is left inside the corporation, it's not going to be eligible for the small business deduction, and it's going to be paying at a higher rate. So again, if you went with a dividend strategy all the way along and you were assessed, I mean, we would fight if you were ever assessed as a personal service business, but if you were ever assessed as a personal service business and you had used a dividend strategy, you are going to be hit with much higher penalties than if you'd used a salary strategy. Because even as a personal service business, salary is still a legitimate expense. They, as a personal service business, they do limit what expenses you can claim, but its salary itself is still a legitimate deduction. And that does reduce any PSP risk that you have. So I do not recommend dividends for IT contractors for a number of reasons. One of them being PSB, the other being that it's not lower taxes. And again, I also like CPP and I also like RSP. So assuming I don't care about CPP contributions, then dividend is clearly the better option. So if you don't care about CPP and you don't care about RSP, yes, you are outflowing lower amounts of money today with a dividend than you are. And again, I'm being very conscious not to say you pay less tax. You outflow less money because you won't be contributing to CPP. So if you don't value CPP and you're like, I'm gonna live hard and die young and I'll never collect a penny of CPP, then maybe a dividend strategy would be more effective for you. But again, keeping in mind that you are also taking some additional risk from a personal service business perspective if you are ever deemed to be a personal service business. When taking a non-eligible dividend, does the corporation have to pay tax on that as well again when the dividend is paid? So a corporation doesn't pay tax when a dividend is paid. A corporation only pays tax when it earns income. But a dividend is paid out of income that is earned, right? It's paid out of income that is not only earned, but has been taxed already. So it doesn't pay tax when it pays a dividend. And in fact, in some situations, it might be eligible for a tax refund. So again, let's go back to our mission for a second. So our mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We often look at the corporation as the legacy because the long-term vision is to create enough wealth inside your corporation that you could invest that, live off the investment gains, and have that nest egg to pass on to whatever is important to you, your legacy. And typically what that means is you're going to be earning investment income, which oftentimes comes in the form of a dividend. When a corporation receives a dividend, it's going to be taxed at a higher rate than the small business deduction income, and it goes into a special tax account called a refundable dividend tax on hand. And again, we have eligible and non-eligible RDTOH, which means if you've received a dividend from a corporation that has paid a higher tax rate, you'll get an eligible recoverable dividend. So you pay the higher tax rate, but when you issue dividends, typically in retirement, as we say, you will receive a tax refund in the corporation for the dividends that you have paid taxes on in the past, up to the point of the dividends that you have paid out now. So you're just getting back because you're flowing through the dividends that you had received, you're flowing them out to your shareholder. And so that shareholder is getting that tax credit from that original investment company flowed through to the individual. Now, prior to the refundable dividend tax on hand, people used multiple corporations to layer that dividend tax credit on top of itself, so they'd get multiple tax credits. So this was a hole the CRA plugged by making the tax on dividends refundable, i.e. the tax credit passing its way through to the shareholder if and only if it was actually declared to an individual, not to another corporation. So I hope that makes sense. When taking a non-eligible dividend, okay, we've answered that one. When during the year I decide to pay a dividend or a bonus. So typically that would be done at one of either two times. Either doing your year-end review, when we're looking at, what have you taken out of your corporation, and you should be sitting down with your account manager to do a tax plan. Be like, okay, are we going to do any income splitting here? Are we going to take this as salary? As we're going to take this as dividends? Or alternatively, you might be looking at this again in say November, December, because you might want to take an additional salary or an additional dividend from your corporation before the calendar year end of December 31st. And that's important because one, you're going to have to pay any source deductions by typically January 3rd, could be 3rd, 10th, or 15th, depending upon your threshold, but that's a topic for another day. And you do need to create either the T4, which is for a salary, or the T5, which is for a dividend by the end of February. So typically you want to be having that plan around November or December if it's not already been dealt with at your corporate year-end filing. What is the difference between eligible and non-eligible dividends? So again, an eligible dividend will be for dividends that are paid out of corporate income that has been taxed at the general rate, which is the higher rate. Non-eligible dividends will be dividends that are paid out of corporate tax that has been paid at the small business tax rate. And again, this is all tracked in your corporate tax return by accountants. We keep track of all of it, and we will be able to tell you whether you have eligible or non-eligible dividends if you are choosing to pay yourself a dividend. And sometimes you will get one T5 slip that has both eligible and non-eligible dividends on that same slip. As a self-employed business owner, if you contribute both the employer and employee CPP in retirement, are you only eligible for the employee contributions or both? No, both. I mean, again, just like if you were an employee somewhere else, you're still receiving both sides of the contribution. It's just one is made from the employer and one is made from the employee. When you were an owner managed, you were effectively making both sides of the contribution because you're both the employee and the employer. But both sides of the contribution are being contributed to your CPP and will affect the amount of CPP benefit that you receive in retirement. The amount of CPP we will receive after 20 years will have no value. The gross up of 135% for which we taxes for between both parties. I don't really even understand what the question is here. So Sashin, I may need you to repeat that question because I'm not really following what you're asking, but the amount of CPP we will receive after 20 years will have no value. The gross up is 135%. Yeah, I don't understand the question. But I mean, I think effectively you're saying that there's no benefit to CPP. The reality of whether there's a benefit to CPP or not is very difficult to calculate because it's dependent on your life expectancy. The longer you live, the more beneficial CPP is, right? And unless you're an actuarialist and or know the day you're going to die, it's very difficult to know the true benefit of CPP. Why I like CPP is it's forced retirement. You know, we've been doing this since 1984. Unfortunately, that means we've seen a couple of boom busts and echoes in the financial markets. And we have seen more than our fair share of clients who thought they were savvy investors, who did their best to save for retirement. But lo and behold, they get to the retirement age and they have to work longer because something has happened to their portfolio investment. CPP, probably not enough to live on here in Toronto, but you could go retire down south somewhere and live off that if you absolutely had to. Which is why I think it's a worthwhile contribution. And I think of it sort of like an insurance policy. But everyone's entitled to their own opinion. There is no right or wrong without knowing the exact day you die. You can't say definitively it makes sense or doesn't make sense. So each person is open to their own, their own perspective and can make their own financial decisions for salary versus dividend based on their own personal feelings. Can we take a shareholder's loan in the interim to pay for day-to-day personal expenses? We do have multiple clients. So you are allowed to take a shareholder loan. All corporations can do a shareholder loan. Most large corporations obviously don't do them. You can take a shareholder's loan. There are rules about interest being calculated on that shareholder loan, which we do for our clients. So you have to calculate interest on those loans. But the benefit of not having to pay taxes until typically the end of the year usually outweigh the cons of the having to calculate that interest on the loan. Now, the other thing to be aware of is that there are very specific rules around shareholder loans. And they say you can't have a net debit balance for more than 1 year. What's a net debit balance? Is that you have a shareholder loan account of, say, $50,000 and you have a salary of $40,000. That's a net debit, because when you subtract the salary from the shareholder loan, you have a debit balance, meaning you owe the corporation $10,000. And you cannot have that for more than 1 year. You also have to be careful of something called a series of loans and repayments. So if you take a shareholder's loan and on the last day of your fiscal year, you pay off that shareholder loan, so the balance at the end of the year is zero, and then you don't take a salary. And then the first day of the next fiscal year, you take the money out again. And then again, at the end of the year, you put the money back in, so you don't have the shareholder's loan balance. That is called a series of loans and repayments. And the CRA will say, no, that's a director's advance. You're going to have to pay tax on that. We don't think that this is a legitimate or an accurate shareholder loan balance. But fundamentally, shareholder loans are a very effective strategy used by most of our clients. What happens if I already started doing payroll payments every month and then I want to pay a dividend instead? Great question. There are ways to get payroll remittances back. The corporation would have to apply to get them back. It is very, very difficult. Takes a while, but it can be done. Usually what we recommend is if you've already made payroll remittances and you want to switch to a dividend strategy, that you still pay yourself a very small payroll amount, and you put the entire remittances that you've made, even if it's an over remittance, then you will get that remittance back when you file your personal tax return in April, or it will be applied against the dividend income. So what I'd say is I'd still go with a T4. In that year, I would do a split between T4 and T5. You can have a very small T4 amount, maybe only a couple $1,000s or something, and the majority of it in a dividend. Now, I don't normally recommend merging both salary and a dividend, because what my belief is here, and there's no right or wrong here, is unless you've got a situation where by taking the full salary, you're going to generate a loss that you can't utilize, then I would say choose one or the other. You're in for a pound, you're in for a penny, you're in for a pound. If you start splitting between the two, you're not really getting the benefit of either. So you got some salary and having to pay some CPP on that. So you're not eliminating the entire CPP contribution. You're getting some RSP room, but you're not getting the full RSP room on the full amount, and you're not making the full CPP contribution. Or maybe you're still making the full CPP contribution, but then again, that's one of the benefits of paying the dividend, is not having to pay into the CPP. And if you're over the maximum CPP contribution amount, you've already maximized the CPP. So you're really getting no real benefit of paying a dividend over a salary. And that comes down to one other thing that I should point out about salary, is that as an employee, you are allowed to tell your employer, look, I've got a whole bunch of other RSP contributions or tax deductions that are going to result in me paying zero tax. So I don't want you withholding any tax from my paycheck and remitting it to the government on my behalf. Now, the employer must withhold and remit CPP, but they are not obligated to withhold the tax if the employee has told them not to. There's a specific form that employees are supposed to use for that. But what that allows you to do is you can, if you're choosing a dividend solely to defer paying taxes from whether that's monthly payroll or January payroll till April 30th, you can defer everything but the CPP to that period anyways, by just not remitting that to the government with your payroll reductions, and using that form to have your employer not withhold the tax from your paycheck or your bonus, whatever the case might be. A capital dividend only exists if it's an eligible dividend. Is that correct? No. So a capital dividend is completely different from an eligible or non-eligible dividend. A capital dividend is a tax-free dividend that the shareholder receives. The reason a capital dividend exists is because there are some other reasons, but what it means is you've got a balance sitting in your capital dividend account, which in most situations comes from the capital gains, the portion of the capital gains that is tax-free. So it used to be 50%, now it's 33%, but you have a tax-free portion of your capital gain. And that tax-free portion is not only tax-free to the corporation, but it's supposed to be tax-free all the way through to the shareholder. So that sits in a capital dividend account until you do a capital dividend election. Well, we typically recommend a capital dividend confirmation to confirm the balances with CRA, and then a capital dividend election. A capital dividend election is completely tax-free to the individual. And again, in most situations is typically you receiving the portion of the capital gains exempt, the exempt portion of the capital gain that you received inside your corporation. So that's a little bit complicated. I hope that's clear for you guys. Can we pay all the salary at once at end of year? What if we receive the contract income for previous year in the next year, say March? Then how do we pay salary to yourself without fines or penalties? So yes, you can pay your salary once. That's the big bonus that we talked about. So you can do salary once a year, as opposed to monthly. And what if you have contract income for the previous year and the next year, say March? That's actually called accounts receivable. So in Canada, you have to use the accrual form of accounting, which boggles most Americans' minds because they don't use the accrual method. But in Canada, we use the accrual method. And what that means is you have to accrue for things that happen during the year, regardless of when you paid them or received the funds for those. So if you earn income during the 2023 calendar year, even if you didn't get paid until the 2024, and I said calendar, but I mean fiscal, even if you didn't get paid until the 24 fiscal year, that is still income in the 2023 fiscal year, not the 24 fiscal year when you receive those funds. Now, what happens inside your corporation is you record the revenue, and you would, instead of putting the money into your bank, it gets put into the accounts receivable account. And then when you receive the accounts receivable, it reduces the accounts receivable and goes into your bank. Now, what if you have contract income in one year and not in another? If you have no contract income in a year and you want to take a salary, well, that would generate a loss. 0 minus something is a negative. That's a loss. Now, if you had income in the prior 3 years, you can apply that loss backwards up to 3 years and get a tax refund inside the corporation, effectively having the same benefit as if you were to take a salary in a year in which you had income. Now, if you had no net income in those prior 3 years, that loss will be carried forward. And if you're not planning to have income in the future, that is, again, a perfect situation where you would say, well, we probably don't want to do salary here. We probably would recommend a dividend in that situation. I love that these questions keep coming. Aside from the annual T5 corporate reporting to CRA by the corporation, what administrative paperwork should your corporation prepare for dividends? I.e., do you need any special records or directors have approved each dividend? Yes, it should be minutes in your minute book with a director's resolution. So that would be the other thing that is recommended. No benefit to CPP based on what we will receive after 20 years will be worthless. Yeah, I mean, that's just, I guess that's your opinion. You might be right. I can't prove it or disprove it. So I'll just leave that to your opinion. Can we do both payroll and dividend at the end of the year? So yeah, I sort of addressed this earlier. Yeah, technically you can do both a salary and a dividend in the same year. I don't recommend it because you should be in for a penny or in for a pound. Whatever strategy you believe. If you don't believe in CPP and you don't believe in RSP, go with dividends, 100%. I wouldn't sort of hedge your bets on this one because then you're not maximizing the strategy of whatever strategy it is that you're believing in. Again, the only exception to that is if you typically believe in salary like I do, but your corporation doesn't have the net income to support that salary, in which meaning it would generate a loss that you couldn't utilize. Is it too late to switch to salary this year? Was taking funds out till date? Does it make sense to switch to salary? October. Yeah. So if you were taking the funds out as a dividend, you absolutely can switch to a dividend. It would have to be an annual bonus. We would consider those funds that you have taken out a director's advance or a shareholder's loan. We would calculate the interest at the end of the year, and we would pay an annual bonus. But no, not too late to switch if you wanted to switch. Leanne Zamporo. Wow. That I wonder if that's the Leanne Zamporo that used to work for us years ago. Pretty cool if it is. Hi, Leanne. I hope that's you. Do you know the form to opt out of tax withholdings on salary? Don't know the name off the form off the top of my head. Um, this is coming out of Facebook, so I will go and find that name and get it back to you and comment back on Facebook later. So I unfortunately don't know the name of the form off the top of my head. Um, to clarify, regardless of your salary frequency, i.e. biweekly, monthly, annually, CPP is required to be remitted monthly. No, not true. The required to remit is a function of when it was paid. So if it's an annual bonus or a deemed annual bonus, you only have to pay it once a year. Now, it is important to go back and let CRA know, hey, I have no employees with any eligible remittances during these other periods, or they will send you letters over and over again saying, hey, where's your payroll? Where's your payroll? There's a form you can actually go and complete online or physically and send it to them that says, I have no employees with any eligible remittances. Again, I can't remember the name of the form, RD7A or something like that, but it can be done. What is required with the CPP, though, is important. You must withhold and remit CPP. When you remit it by is dependent on when the employee was paid, but you must always withhold and remit CPP if you are paying a salary, whether it be an annual bonus or a monthly. Dividends are great for me as I can manipulate my taxable income and stay within a certain tax bracket. You can manipulate your taxable income with salary or dividend the exact same way. So I don't really understand that point. I mean, the biggest limiting factor is what have you actually taken out of your corporation? We have a little bit of leeway with being able to carry a debit balance for 1 year, but generally speaking, if you're taking the money out of your corporation, it's going to have to be either salary or dividend. And they're both going to be taxed, like I said, the same way. So don't see how choosing one over the other allows you to manipulate it any better, but maybe there's something I'm missing. Um, can you buy a property using a director loan for incorporation and get the rental income as director income dividend? What are the pros and cons of that? I don't think so. It's not very clear what you're saying, but you want to take a director's loan from the corporation to buy a rental property and then consider that personal income, I think is what you're saying. Um, so, you know, I mean, technically you could, but you have to repay that shareholder loan by the end of the year, by the end of the second year at the very latest. So it's not a very effective strategy for getting money out of your corporation to be able to invest personally. There are other tools like ICE loans and ICE maneuvers where you can you leverage insurance to get that money out of the corporation more effectively than that. That is not the way I would recommend doing it if you're looking to get money out of your corporation to put into a personal investment. I mean, although technically you could, but that money would have to be repaid, like I said, by no later than the second fiscal year in which it was withdrawn. Can you expense pension plans from your business income, or is that from after tax dollars? So yes, the employer portion of CPP is a deductible expense inside the corporation. We usually put it on our employee benefits. And in addition, if you have an IPP, which is an individual pension plan, that is a deductible expense from the corporation. The employee portion is not a deductible expense of the CPP. So yes and no, if that makes any sense. Can you pay your kids a salary and how much? Yes, you can pay your children a salary. How much is dependent on what they're doing for you in the business. Because unfortunately, a salary, and the reason we used to do dividend income splitting in the past instead of salary income splitting, because the dividends weren't subject to a reasonableness test. A salary is subject to a reasonableness test, which means is the amount of salary that you're paying this individual reasonable for the amount of work that they're doing. But that being said, typically the amounts of money that you're looking to do income splitting, which is usually to bring them either over the basic exemption or over the, up to this, top of the lowest tax bracket. There's usually lots of things that children can do in the business that don't take a lot of hours where we can reasonably justify a decent salary. Things like social media, websites, stuff like that, which typically command higher salaries. And typically their children know more about that stuff than you do. At least my children know more about it than I do. Can we pay a dividend if you are showing a loss or carrying forward the losses? Please explain. So you can have a loss in an individual year and still pay dividends. However, you have to have retained earnings. So let's imagine that you have a year in which you have a loss, but you have had 5 years of making profits, and you've got a bunch of retained earnings in there. And even taking into account the loss, you still have retained earnings in your corporation. Then yes, you can take a dividend. But if you don't have any retained earnings, you can't take a dividend because there's no dividend to pay, or there's no retained earnings to pay dividends out of. What happens if I already started paying CRA every month, payroll monthly salary, but then I realize I only want to pay them once a year and declare a bonus? What are they going to call me and ask me to pay them every month? I got a phone call one month, then I didn't pay on time. They asked me a lot of things and I didn't know what to respond. So don't respond on your own. Use an accounting professional who knows what to say. But generally speaking, the answer is I have no employees with any eligible remittances during that period. And then go fill in your PD7A form or whatever it is that tells them that you have no employees with any eligible remittances so that they're not calling you. That's that form I was telling you about that can be really helpful to making sure that you don't get those phone calls. And if you do get those phone calls, have your accountant deal with it. Or if you're confident, you just simply tell them, I have no employees with any eligible remittances during that period. Thank you. When do I expect to have employees with any eligible remittances? In December or February, whatever you are planning to do that bonus. Dividends can be paid only to shareholder. Correct. Yes, absolutely. So you can only pay dividends to shareholders. Another thing to be aware of is if you have one class of shares, let's say common shares, which is the most common, and the default, as opposed to preferred shares, which we always make sure we have different classes of preferred shares for all family members when we incorporate someone. But if you only have one class of shares and you have 50% of the shares owned by you and 50% of the shares owned by your wife, then if you issue a dividend to that class of shares, let's say you issue a $100,000 dividend, it gets split 50-50 based on the number of shares owned by the people who own that class of shares. So you are issuing a dividend to that class of shares, not to an individual. So if you both have common shares and you both own 50% of those common shares and you issue a $100,000 dividend, then you're each getting $50,000. If you owned 75%, your spouse owned 25%, she's getting 25,000 and you're getting 75,000. So tax structure is absolutely important. We scream this from the rooftops, and yet we see people screw up their incorporations all the time with how they do their share structure. So it's really important to make sure you're doing your share structure properly so that you can do tax planning when it comes to dividends effectively. What is the best way to invest money that stays in the corporation account so that it generates some returns instead of a very low bank savings account interest. So again, I'm going to preface this with I'm not a financial advisor. I would recommend working with a financial advisor, and working with a financial advisor that is a fee for service advisor. What I mean by that is that they typically charge what is called in the industry a wrap fee, which is a percentage of your portfolio. So as your portfolio grows, they make more money, as opposed to someone who's peddling mutual funds, which is getting a kickback on every mutual fund that they recommend to you. And often, poorer the mutual fund performs, the more benefits there are to the financial advisor of recommending that stock in the form of MERs, which is what the broker is receiving as far as a benefit. But you can invest in stocks, you can invest in real estate, you can invest in index funds. There's so many things that you could invest in. And if you don't know anything about the market and you don't have a financial advisor, probably low cost index funds are the way to go. And if you're just learning about investing, there's a great book by Tony Robbins called Money Mastering the Game. Read that book. It'll give you some great introductions on how to invest your money effectively. And that applies to whether it be in your corporation or outside of your corporation. Can you talk about the case of putting corporate money into a mutual fund and the dividends going back into the corporation? So I think you're meaning so let's say that you invest in a mutual fund or stock that pays dividends into your corporation. So your corporation is going to receive dividends. It is going to pay tax on those dividends today. And it is going to sit in a special holding account called a recoverable dividend tax on hand, or RDTOH. It could be either eligible or non-eligible depending upon the type of dividend that you received. Typically from a mutual fund or a stock, it's going to be an eligible dividend. Now, if you issue a dividend to the shareholders of your corporation in that year, you'll pay the tax, but then you'll get a tax refund in the same year. So effectively, you're not going to pay the tax on those dividends in that year. Now, if you don't pay yourself a dividend in that year and you wait 2 or 3 years and you pay yourself a dividend, the corporation is now going to receive a tax refund, a refundable tax, which is the tax you paid on those dividends from that mutual fund or from that stock. And the corporation gets that back. Has nothing to do with the shareholder. The shareholder is still going to get the dividend tax credit as well as the dividend gross up. And that dividend tax credit, if we're issuing an eligible dividend, would be an eligible, would mean you get that higher tax credit. So that's why sometimes when we issue dividends from the corporation, it could be split between eligible and non-eligible, because you might have some eligible dividends for dividends you have received within the corporation, but you wanted to pay more than you have received in dividends. So you have part of it is eligible and part of it is non-eligible because you have paid small business tax rate on some of it. With no tax payable for incomes up to approximately $15,000, if you paid a non-working spouse via dividends totaling under $50,000 and the spouse had no other income, would the TOSI be net zero? Since I mean, to be honest, I would have to run the numbers and calculate it. But I mean, it is possible that you could still be at net zero with a dividend, even with the TOSI, but you would still be better off using the dividend. And I'm not even 100% sure on that. Like, I see what you're trying to propose, and it's possible. I've never actually checked to see what the net tax would be. But again, either way, you would still be more beneficial to your spouse taking the salary as opposed to a dividend. But I guess if you're saying, hey, there's no other way I could justify it, maybe, and I'm not 100% sure. Again, I'd have to double check. So I don't want to make promises there that I'm not certain of. Is there a ballpark threshold for each type of expenses that one can say one can claim for $100,000 contract income? So what I would recommend is you can go to our website and run a benchmark analysis. So just go to our website and look for the benchmark analysis. You can give us your information and we'll send you back a benchmark analysis that will show you how you compare to the average and the median in our database. Um, that doesn't mean that there's a threshold that you're allowed to deduct. That'll just give you a ballpark of what the average person is claiming. There is no threshold, like there's no limit to the amount of expenses that you can claim. However, they again have to be reasonable and they have to be incurred with helping your business earn income, and they have to not be specifically disallowed by the Income Tax Act. So, but there's not a dollar figure on what is reasonable. That is a subjective description. Can you change the share structure at a later date? Yes, you can. Um, that can be either very easy or very difficult, depending upon what your retained earnings are. If your retained earnings are 0 or less, very easy to change. If you have retained earnings, it gets more complicated because there are attribution rules that basically say any income earned prior to you changing the ownership can only be attributed to the shareholders who existed prior to you changing the ownership. But it can be done, and it's done with usually an asset freeze and some rollovers. But you need a tax return to do that, but it can be done. Um, I'm more than happy to offer a free consultation, Andrew, to discuss any share structure issues. So again, that's my colleague Karen chiming in just to say, hey, if you've got questions about share structure or redoing it, come speak to Karen. She'll be happy to talk to you and let you know whether we can do it, meaning it would be relatively inexpensive and easy, or whether you need to bring in a tax attorney and it's going to cost you more money and be more complicated. But it looks like we've gotten through everybody's questions, and we are just over time here. So thank you, everybody. I appreciate you joining our session, and I love the questions. We had 38 questions in the session. I think this was an all-time high. We knew there was lots of questions around the subject, which is why we wanted to host this session, which I know that the slides were pretty generic, but these questions are where the meat is. So thank you for asking your questions and for joining us on this session. And again, if you still got more questions, reach out to your individual account manager, or if you're looking at changing some share structure, Karen's our paralegal who can assist you with that. Thanks, everyone, and have a great day.